In this video, I'm going to give you the best trading strategy for 2026, and this will work for you if you're a complete beginner with no experience, or even if you've been trading for years, because this strategy is by far, hands down, the simplest model in all of trading. And if you don't believe me, go look at all these traders on screen now who are already using this trading strategy. So in this video, I'm going to walk you through the model step by step, and if you stick to the end, I'm going to give you a few bonus tips which could massively increase your win rate. Okay, so for this trading strategy, all we're going to do is we're going to use the 4-hour chart. Now, this will work for whatever market you trade. For this example, it's on gold. This will work for indices, futures, forex, stocks, crypto, whatever you like to trade, this will work. But the first thing we're going to do is we're going to get the 4-hour chart up, not the daily chart, not the 1-hour chart, but the 4-hour chart. I'm not going to tell you why. All you need to know is it's just the highest probability time frame when it comes to doing your analysis. Now, most traders, let's be honest, most traders don't struggle with an entry. It's pretty easy to find a pattern and enter on. Most traders struggle with the bias. Like, be honest, have you been struggling with the bias? Probably, right? Now, this strategy right here, the reason why it's so simple and so good, and all those traders in the beginning of the video were having success with it, is because the bias is built into this strategy. Now, what I mean by that is literally all you need to do, there's no daily bias, there's no complicated analysis, is you simply get the 4-hour chart up and you mark out the most recent fair value gap in price action. Now, if you don't know what a fair value gap is, I'll put a nice picture on screen now. Just take a screenshot. If you haven't seen it before, put it on your wall and look at it. You'll see this happen a lot in price action, but what a fair value gap is, it's the gap between this candlestick's low here and this candlestick's high here, right? That is a fair value gap. And all you're going to do on the 4-hour chart is you're going to mark out that 4-hour fair value gap. Let's move it up a bit more like that. And then what we want to see on the lower time frames is we want to see what does price do when it actually hits this 4-hour fair value gap. And there's really, let me just move this out. There's really 3 things that can happen in any market. Most people only think about 2 things, but there's really 3 things that can happen. Number 1, when price hits this fair value gap, right? Let's imagine this is now the 5-minute chart or 15-minute chart. Price could just smash right through it, right? It could just maybe stop for a bit and then smash right through it. That's one scenario. The second scenario is price hits the fair value gap and just consolidates for ages, right? And we don't want to see any of these scenarios. What we do want to see though is we want to see price hit this fair value gap, start to reverse off, give us a high probability retracement, and then ride price down, right? That is what we want to see, because that right there is confirmation that this fair value gap, which remember, let me just remove this, it's a bearish fair value gap. That right there is confirmation that we're on the right side of the market. You never guess in trading, you never gamble, you always wait for confirmation. You let smart money, those with billions, show that hand. So this strategy has it literally built into it. So we've marked out the 4-hour fair value gap. We are done with our daily bias top-down analysis. All we're going to do now is we're going to get onto our lower time frames and look for confirmation. Now, you can use any time frame below the 4-hour chart, the 1-hour or whatever. For this example, I'm going to use the 15-minute chart. And if you use the PDF for this strategy, which is in the pinned comment down below with all the screenshots, all of the examples are using the 15-minute chart. Now, you might like the 1-minute chart, you might like the 5-minute chart, really doesn't matter. Just pay attention to what I'm going to tell you here, because this, you can forget that this is a 15-minute chart, right? It'll work on all time frames. But what we're going to do is we're going to zoom out. So this is the 4-hour fair value gap that we talked about. Now, what we want to see, and you know how I said we want to see confirmation that we're on the right side of the market? We want to see price hit this fair value gap, shoot off, give us a retracement, and ride price down. Now, this is really important, so make sure you pay attention here. If you're a day trader or scalper, you need to be trading at key time of day. Now, I'm going to put up the 3 major sessions, which is London session, New York session, and Asia session on screen now, right? And we only want to be trading during those sessions because that's going to give us the highest probability setup. However, there is one little bonus tip that I was going to give you, and I mentioned towards the beginning of the video, is Sunday's price action. I don't think I've ever explained this in any video whatsoever, so make sure you pay attention. Can you see at the bottom? Look at this bottom right. See how it's Sunday's price action? So this is Friday and Sunday's price action. So some traders are going to hate me for saying this, but for me personally, what does Atif do? I always skip Sunday's price action. It is low volume and it is low probability. Always skip Sunday's price action. Just wait until London session. So for me, the trading week doesn't start until London session Monday morning. I always skip Sunday's trading because it's always low probability. So for me, 2 a.m. Eastern, see this? This is the beginning of London session. So right here, we're going to start to look for our entries, right? Super important. Right here, we're going to look for our entries. Now, do you know how I said, basically what we want to do is we want to skip, just avoid all of this low probability Sunday price action. And you can just tell, right? Can you see these small bodies, large wicks, and very low probability price action that we want to avoid. And instead, we want to put, let me just get the vertical line up actually. What we want to do is we just want to look at London session and above for our entries, right? We do not care about any of this, but what we do care about is we want to see price hit the fair value gap, shoot off, give us a retracement, and then hopefully right price down. So what do we really want to see, right? You know how I've said that we want to see confirmation, we want to see price reverse, we want to see that we're on the right side of the market. What we really want to see, right? Let me just remove this. What we really want to see is we want to see a new fair value gap to form, a new bearish fair value gap to form, because that right there is confirmation that we're on the right side of the market. Can you see our price wicks? There's lots of wicks here, and it's showing Sunday's price action. Very low probability, and then during London, or during just before London, price comes in, it shoots off, it leaves us a fair value gap, spikes up, and then shoots down, right? What we want to do, what we want to mark out, is we want to mark out this fair value gap in price action, right? The moment this fair value gap forms on the 15-minute chart or whatever time frame you're trading, that right there is smart money screaming at you that this fair value gap's actually going to hold and that there's going to be a larger reversal, right? So the fair value gap on the lower time frame is the confirmation that we're on the right side of the market, right? This bullish fair value gap, I do not care whatsoever about this fair value gap right here, because remember, this was a 4-hour bearish fair value gap. Super important. So the first bearish fair value gap that forms on the lower time frames, that right there is our confirmation that we're on the right side of the market. Now, don't worry if that doesn't make sense to you or if that seems complicated. In the PDF or in the pinned comment down below, you get the full PDF of this, right? Explain every single detail step by step. All you need to know is the moment this fair value gap forms, we start looking for our entries. Now, let's just remove this because we really do not need it. There's essentially two types of entries that we can have. The first entry is we can enter right here on the fair value gap and we can put our stop all the way up here. Now that's a pretty big stop loss, right? Now me personally, I do not want to have a stop loss that's that big. Instead, what you can do is the moment this fair value gap forms is you don't have to enter on this fair value gap, right? We don't have to do that. That's just there if we like it. What we can do instead is we can enter on the order block. Now, if you don't know what order block is, I'll put a nice picture on screen now that you can study. It's essentially when you're bearish, the last up close candle before the down move is an order block. So this little doji candle right here, this is our order block. So what you would do is simply mark out the order block, and let's remove the fair value gap because we really don't need it at this point, and simply enter on the order block, put your stop at the high. Let's remove this now, and then for your take profit, you can target, you know, for me, always a 3-to-1, or you can just target liquidity low all the way down here. Really does not matter, right? The key thing is the 4-hour chart, 4-hour fair value gap, and getting the confirmation on the lower time frames that you're on the right side of the market. So let's just play this bit of price action. I actually have another bonus tip, so make sure you pay attention to what I'm about to tell you now. So let's just play price action, see what it does. This is really important now. Really, really important. So some people will say, oh, Atif, you know, what happens if I miss London session? Or, you know, whatever. Let's say you trade London session and then there's an entry during Asia. So you basically miss a setup. What do you do this time? So this is super important, right? You can take second entries. Whenever you take a second entry, it's always going to be lower probability, but you can still take it right now. And for those who don't know, this is New York session. New York session is almost always a continuation of London. So London was obviously bearish. New York, little retracement, moves down, and you can right price down. So what this really means, especially for this strategy, can you see how we hit the 4-hour fair value gap again during a key time of day, and then price shoots off? It leaves a little fair value gap here, which is fine, and then gives us a retracement, and then hopefully we can ride price off. So what you would do this time is, let's say you trade New York session, you missed the trade here, wait for price, so price hits the 4-hour fair value gap, wait for the new fair value gap to form. This is your confirmation, and you can see right now, you can start to see how the fair value gap isn't as good as this one over here, right? You can start to see that now in price action because the probability is getting lower. However, you can still take setups, right? You can still take setups. So I'm not going to limit you to just the first time entry, because this right here is the first time price enters the fair value gap. This is a second time it does. So for your entry, you don't have to enter on this fair value gap. In fact, I'd recommend not doing that. You can just enter, like we said, on this order block right here, last up close candle before the down move, like that. Simple stop at the high. For your take profit, what you're going to do, you're going to target 3-to-1 like that. Or, and this should always, this is super important, right? This should always be the maximum take profit that you have previous days, high or low, right? Like that. That should always be the maximum. Do not target, I don't know, whatever that is, previous week's low. Just leave it on this, and then let price do its thing. Look at that. I always say that and the price goes straight all the way down there, but you guys get the point. I mean, you can get the PDF of this down below in the pinned comment. I explain all this with text, with screenshots, and if you want more examples, go look at this playlist on screen now.